Hey everyone, welcome back to the channel. Today we're going to talk about gold, silver, how we closed out the month of June 2024, and finally, what I think is in store for precious metals and inflation for the back half of the year. Before we start, everyone knows the drill here. The thoughts and concepts presented in this video are in no way a recommendation or suggestion that the viewer take any action with their own portfolio. Action requires research and the assistance of a financial professional who is familiar with your specific financial situation. Now, let's take a look at the month that was. First off, let's take a moment and survey the lay of the land. In June 2024, the global economy experienced a continued period of cautious optimism amidst fluctuating growth rates and persistent geopolitical tensions. Major economies, including the United States and China, are witnessing moderate economic growth, fueled by resilient consumer spending and ongoing technological advancements. However, inflationary pressures remain a concern, driven by supply chain disruptions and volatile energy prices. Central banks worldwide are adopting a balanced approach to monetary policy, striving to control inflation without stifling growth. We'll talk more about the inflation environment later in the video. For precious metals investors, this economic environment presents both opportunities and challenges. Gold and silver, traditionally seen as safe haven assets, continue to attract investors seeking to hedge against inflation and economic uncertainty. The Federal Reserve has been closely monitoring inflation and economic growth, attempting to guide the economy to what is believed to be a soft landing. Recently, the Fed has adopted a cautious stance, halting rate hikes that had been intended to curb inflation while avoiding significant economic slowdown. It is a difficult needle to thread for sure. Some forecasts suggest potential further increases in late 2024 and early 2025 if inflation remains persistent or rises. However, if economic growth weakens or inflation continues to subside, the Fed may continue to pause or even lower rates to stimulate the economy. And it is with this backdrop that we look at the performance of gold and silver. Let's look at silver first. After flirting with $32, stackers once again ran into a wall of selling, driving silver back below $30. As we've been talking about for the last few months, prices have entered into the absolute worst kind of market for most people. You can clearly see that we are continuing to absorb the moves of the last half year. This means for the anxious or impatient, you are at a moment of potentially highest risk, because it seems like every time we start to move up, sellers turn buyers into exit liquidity. Just sitting on your hands and doing nothing can be challenging for anyone, but it's probably the best choice for today's silver market. So welcome to the summer of the wood chipper market. And in a wood chipper market, goal number one, the playbook, is to simply stay in the game, to live and fight another day. And I think we can look back to 2022 and 23 for an example of what a wood chipper market looks like. It looks like a year and a half of going exactly nowhere. But in the process of going nowhere, stackers are whipsawed from what feels like one extreme to the other. We're breaking out. No, we're crashing. We bought high, intending to sell higher, but instead sold into the lows as price flirts with the 20-week simple moving average and a 21-week exponential moving average. What is interesting is that for the first time in recent memory, silver's price has run well ahead of these averages, and I believe we're in the process of gliding back down to meet them. And until that happens, we should expect additional churn and generally going nowhere. So, if someone can't stomach this action and welcome it as an opportunity to eventually turn resistance into support, precious metals portfolios will be turned into mulch for the neighborhood playground long before the next move happens. Finally, maybe there is a ray of hope for silver stackers, though, and that comes in the form of the massive cup and handle pattern that we've been forming for the last decade and a half. We've completed the cup. We're damn near close to completing the handle. So if I'm going to speculate, I believe that we continue to churn, ultimately meeting up with the moving averages before the seasons change again. And as long as I'm speculating, I'm wondering if this move back to the averages will also form a bull flag. And if I'm correct, that will be the point where we break through $30 and beyond the selling zone that has foiled stackers for some time. Therefore, I'm neither adding or selling additional silver here. As a reminder, I did sell silver and buy pre-33 gold recently. My bias is always to turn silver into gold. While there are some similarities between the gold and silver charts, I do think there are a few divergences too. Gold has had a longer and more substantial move compared to silver. At the same time, gold hasn't flown as close to the sun as silver, and it has stayed much closer to its averages. As such, I think gold has the stronger case for holding the trend because it just behaves better than its little silver brother. Gold effectively finished the month as it started, hovering around $2,330. Gold seems to be moving with less velocity, despite central banks around the world adding gold to their vaults. I think the biggest factors that can potentially move gold are inflation and interest rates. If inflation reverses course and heads higher, you can expect that it will take more dollars to buy the same amount of gold. So, price likely goes up. Gold is also beholden to the federal funds rate, specifically the behavior of the 10-year Treasury. The 10-year ended the month at 4.4%, down from 5% when rates bumped into it and reversed before making a lower high in April and May. Should the street sniff out any rate cuts at the back half of the year, we'll see the 10-year break and fall into the 3s. It is also possible that falling rates will rekindle inflation as the increase in liquidity results in dollars looking for a higher return. So, price is likely to go up again. Between May and July 2024, the Consumer Price Index, CPI, and Producer Price Index, PPI, have shown notable shifts. The CPI, which measures the average change in prices paid by consumers for goods and services, experienced a moderate increase. This rise was primarily driven by higher costs in energy and food sectors, reflecting ongoing supply chain disruptions and geopolitical tensions affecting commodity prices. Meanwhile, the PPI, which tracks the average change in selling prices received by domestic producers for their output, also saw an uptick. This increase was influenced by elevated production costs, including raw materials and transportation, which manufacturers partially passed on to consumers. These changes indicate persistent inflationary pressures in the economy. The Fed's response through interest rate adjustments aims to balance controlling inflation without stifling economic growth. But what about what is going on underneath these numbers? Well, I would highlight the analysis of Tom Lee, head of research at FundStrat Global Advisors, who has a positive outlook on inflation in the US and one of the best track records of illuminating where markets are headed. Lee believes inflation is on a downward trajectory and will fall significantly through the rest of 2024. He points out that real-time data, such as home and rent prices, are stabilizing, even though official statistics may show elevated levels due to reporting lags. This expected decline in inflation could lead the Federal Reserve to cut interest rates, providing more support to the stock market and easing borrowing costs. Lee's optimistic view is grounded in the belief that inflation pressures are easing faster than the consensus expects, which could alleviate the cautious sentiment among investors and drive a continued rally. This scenario suggests a more favorable economic environment, reducing fears of prolonged high rates and potential recession. Lee's view feels right to me. I continue to buy gold at these levels. However, it is taking the form of pre-33 gold versus bullion, as the premiums on pre-33 gold are very low, and grabbing eagles and double eagles in mint state 61 to 64 can often be had at near melt. Thanks again for joining me for this look at the closing gold and silver prices for June 2024. If you enjoy and value content like this, please hit those like and subscribe buttons. I appreciate it. Until next time, cheers.